Kyle owns 100% of his C Corp with 3 full-time employees who are all family members. All 3 family members are married with dependent children. So, a lot of times an employer may not want to offer a really generous package to a lot of employees, but if it's a family business, they want to take care of family, right? And we work with a lot of family-owned businesses. So Kyle, obviously likes his family. I'm assuming he works with them, although sometimes when you work with your family, you end up not liking them. So he offers them a QSERA with the maximum family benefit. The C Corp deducts it. It's tax-free to the employees, and nobody pays payroll taxes. But if it's an S corporation, it's a huge problem because direct 2% owners and 2% owners by attribution, which includes certain family members, can't participate. So it's possible that most or all of them would not be able to participate if it's an S Corp. Okay. Is this a factor in choice of entity? 100%. 100%. So these are the kinds of things we need to think about. All right. We are going to spend the rest of our time today talking about one of my favorite topics, which is, drumroll, health savings accounts. When I was a baby EA, and that was back in 2010, 2011, only a couple of years of my license, 2 years actually. For like 2 years, I had the ability to contribute and save in an HSA. And I promptly just used the money in the HSA and didn't do anything fun with it. And I have to say, of all the things financially I've done in my life, that's one of the top 3 regrets I have is not knowing or realizing what the power of having an HSA could have done for me now, almost 15 years later. So I'm just saying that to say a lot of people aren't aware of the power. They're often called triple tax advantaged because, one, the contributions are tax deductible regardless of income, which, a lot of times we're looking for deductions for high income earners. This is one of them. 2, the amounts grow in the account tax deferred. And then 3rd, if you take them out for the right reasons, they're tax-free. So you get a tax benefit on the front end and the back end. It's basically a melding of a traditional and a Roth IRA. It's also portable, right? So if you change employers, change insurance providers, leave the workforce, you still have this account you can use. And it's really powerful. And honestly, as we're going to see, the best time to offer this is when someone is relatively young and has relatively few medical expenses. Because if you can set them up early and take advantage of some of these benefits, it could be a huge, huge benefit in retirement.